Good morning, everyone. We are live. Krishna, let's start.
Hey, we are live here. So, welcome everyone to the session on momentum investing. My name is Krishna Appala, and I'm Senior Research Analyst at Capitalmind Premium, where I manage focused portfolio, a fundamental
Good
portfolio
morning,
from
everyone. We are
Capitalmind.
live. Krishna, let's start.
Hold on a Hey, we are live here. Yeah, sorry, some technical glitch. We are starting again. Uh, so, this is Krishna Appala, and I'm Senior Research Analyst at Capitalmind Premium, where I manage focused portfolio, a fundamental portfolio from Capitalmind. Today we have with us Nihit, who manages momentum portfolio at Capitalmind Premium and Small Case. Today we are going to discuss about momentum factor and how we incorporate this strategy at Capitalmind. In fact, Capitalmind Momentum is one of the longest running portfolios on small case platform, having completed little over 5.5 years, and it has been quite a journey. Whether you are already an existing investor or interested to learn more about momentum investing, this session is for you. We'll discuss about the nitty-gritties of factor investing, what are the principles of momentum, why it works, why it doesn't work, and more importantly, we want to keep this interactive. So please ask your questions in the comment section, and we'll make sure to take them at the end of the session. So let's hear from Nihit. Hey Nihit, how are you?
I'm good. Thank you, Krishna, for the introduction. And thanks, everyone, for joining on a Sunday morning to talk about momentum investing. Before we get started, a quick disclaimer. So, everything we talk about here is for your information purpose only. Nothing here should be considered as an investment advice. And rather, anything that you see on the internet or on YouTube should not be taken as investment advice. Do your own research or talk to an investment advisor for an investing decisions. That said, today's talk is going to be jargon free, and we will talk about four things, and the fifth one is taking your questions. Firstly, we'll start with defining a factor and what constitutes a factor. And then we'll look at some cool data where we are seeing what happens if you buy stocks at 52-week high versus what happens when you buy stocks at 52-week low. And there's a superb insight there, so watch out for it. Third, we'll talk about four key principles of momentum investing. We have kept it very simple, easy to understand, but it is what momentum investing is. And then we'll talk about things you should consider before you invest into a strategy like momentum through small case or through yourselves. And finally, as I said, we'll take your questions. And before I start, in the chat window of your YouTube screen, you can ask questions and Krishna will pick it up and will answer them for you at the end of the sessions. Also, if you have any comments, if you want to say something, just use the chat window. Feel free. It's a Sunday morning. First things first. So what is factor investing? Taking the example of cricket and if you haven't seen enough of this pic, here it is once more, the World Cup trophy. So how do you pick batsmen for a cricket team objectively? Now we are currently at a point where we don't have the liberty to pick Virat Kohli or Rohit Sharma in the team because they have announced their retirement. So now you need to pick new players. You need two new batsmen at the opening of your batting order. How do you pick these players? Do you look at average? Do you look at strike rate? Do you look at their overall fitness? Do you go for experienced players? Or is there anything else that you look into? Now, each of these parameters listed for a batsman is potentially a factor on which you will pick them. Because, as I said, you don't have the liberty of knowing everything about a player. So you'll go with statistics, you'll go with past records. And that is the broad definition of a factor. Now, if I apply the same logic to picking stocks, suppose you don't have the knowledge of knowing a company like Reliance or HDFC, but you have to pick a company based on factors or based on things uh, which are which are working in the stock market. Just like strike rate is a good parameter to pick a batsman in a T20, maybe a company with the largest free float is a good factor. Maybe a company which has a cheaper P ratio is a good factor. Or is 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 picking company which has a headquarter in Mumbai a good factor? Or Should you pick up companies whose promoters are foreign educated? Now, all these are factors, but the question is, which of these is a good factor? Which of these is an effective factor? Which of these factors will help you essentially get better returns? Or which of these will help you beat the index? So now, uh, this is adapted from a book by Andrew Birkin, and here are the conditions that help you define a reliable factor. The factor should be persistent. Eh, Whatever factor you pick, suppose you are picking stocks with cheaper PE, then that factor should work over time. That factor should not have worked in just the last 3 or 5 years. It should have worked for a longer period of time. Second, the factor should be pervasive. The factor should work across different markets. A factor that works in Indian market and does not work in, say, a US market, that's not a pervasive factor. Also, the factor should work in different asset classes. You should be able to apply that factor across, say, stocks or maybe bonds or to other investable classes. Second, the factor should be robust. The factor should work for different different but similar definitions. For example, if you are picking stocks, if you're taking a factor called value, so then it should work for stocks with lower P. It should work with stocks which have lower price to book. So similarly, if you're picking value as a factor, then it should apply, and it should be you should be able to apply it using different definitions. We'll look into this in the next slide. Third point is the factor should be investable. Suppose you figure out a factor, but all that factor does, it gives you stocks which are illiquid. Now you can't invest in illiquid stocks. So then that factor, though it works in theory, though it works in your back test, but it is not implementable. So your factor should be investable. Third, it should be intuitive. There should be some logical reason why that factor is working. Suppose if you run a test and you find out that all the companies headquartered out of Mumbai, or all the companies that have blue color in their logo, are able to beat the index. But that's not intuitive. There is no logical reason why putting blue color in your logo should beat the market. But as per data, it is working. But there is no logical reason behind it. Such factors also are not ideal factors or reliable factors. Now, applying these definitions, these are the four core factors that have come up in academic research and have been uh, widely used. They have been widely debated, and these factors are quality, growth, value, and of course, momentum, which we are going to talk about today. So, when we said that the factors should be uh, robust, so if you're talking about the value factor, then you can say that you can define the value factor by looking at low P ratio, low PB ratio. If you look at the growth factor, then you can apply the growth factor using a company which is growing in revenues, a company which is growing in profits. Similarly, if you apply a quality factor, then you can apply it to any metric that shows that the stocks are having a sound balance sheet. So good ROE, good ROCE, better debt to equity ratio. Similarly, for momentum, the factor we are looking at is, or the feature that we are looking at is, we pick the stocks that are rising in price. So you can look at last 3 months, 6 months, 12 months price change. You can look at something like RSI. You can look at moving averages. You can look at Sharpe ratio. You can apply any of these metrics and come up with a set of stocks that are displaying price momentum. But the question, and we get this asked a lot, that how does it help in picking stocks that are at 52-week high? Or how do you pick stocks that have already run up so much, and you add them in a portfolio called momentum portfolio? So we did a data experiment. Stay with me on this. What we did is we took 20 stocks. We created a portfolio of 20 stocks, and we added stocks that were at 52-week low. And every month we rebalanced that portfolio. We did this we took data from 2007 up to 2024. Now here you can see that Nifty has given a return of 600%. So we started with 100, we ended up at 700. Whereas if you pick stocks at 52-week low, we have got a return of around 300%. Now we flipped the equation and we said that what happens when you buy stocks which are at 52-week high? So every month we picked stocks which are at 52-week high, we added them into the portfolio, and every month then we rebalanced with the same logic. You'll be surprised to see that picking stocks at 52-week high is also not beating the Nifty. But it is doing better than picking stocks at 52-week low. So what this tells us is buying stocks at 52-week high is a better strategy than simply buying stocks at 52-week low, which is also called bottom fishing, which is a very basic way how an investor starts, that they go to a list of stocks and look at stocks that are at 52-week low and they buy them. But that does not work. You're better off picking stocks from a list of 52-week high stocks. But yet you're not able to beat the index. That means even when you're picking stocks at 52-week high, you need to do something extra. You need to add a certain filter so that you're able to pick stocks in a way that you can beat the market. In a way, momentum investing does this. It does pick stocks that are on an high, but with additional filters, we are able to uh, generate returns that are better than the index. Uh, i- so let's look at four principles, and we'll keep it really simple. Let's look at four principles, how momentum investing or how we filter out stocks to be added into a momentum portfolio. Firstly, we look at stocks that are relatively stronger from a target universe. Suppose you reached at a universe of stocks where you get a list of stocks that are all showing momentum. But we pick up stocks that are relatively stronger, and then we create a portfolio of those stocks. Second, momentum investing picks stocks where the momentum of a stock is already proved. So in this chart, you could see that we enter a stock after we have already established that there is momentum, and then we hold on to it. And when you see the exit happens only after the momentum is lost, which also means that you will not be able to pick stock at the bottom of the cycle, nor you will be able to sell it at the top. But we are okay with it. Third, whenever all things are equal, suppose you get two stocks, both are showing momentum, both are showing the kind of moving averages, the kind of Sharpe ratio, the kind of relative strength index, and you're convinced that these both stocks are great momentum stocks. But then which one to pick? Then we go with the stock which is showing lower volatility. And fourth principle is that we we systematically replace stocks which have lost momentum, and we hold on to the stocks that are still showing momentum, which is the probable saving of let your winners run and cut your losers. So in this chart, you can see that if we start with four stocks at the same time, then we are very quick to exit the stocks that have lost momentum while we keep holding the stocks that are still showing momentum. Now, this fourth principle is displayed in this chart. So this is real data from our Capitalmind momentum small case, and this is taken since Jan 2019. So all the reds are the exits, uh, all the reds are the losers, and all the greens are the winners. And all these dots show all the stocks that we have exited from the portfolio. As you can see on the bottom left corner, the reds and the greens are in a cluster. So these are all the stocks that we have sold in a very less period of time. And they basically, you'll see these dots will even out. But what stands out is on the top right corners, where you see that stocks that we have held for long have given phenomenal returns. And this is where the strength of momentum investing comes in. You'll be surprised to know that almost 50% of the stocks that are added to a momentum portfolio end up being sold at a loss, but the rest 50% more than make up for it. Now, these were the these this we took you through what is factor investing, a very broad overview. We also took you through momentum investing on how momentum stocks are picked and the principles we use. Now, Let's look at things you should consider before investing into a momentum portfolio. Firstly, you should ask the question, are the costs reasonable? And I'll explain this with an example. Suppose if the fee of a small case or any portfolio that you're subscribing to is 10,000 rupees, and you're saying I'll invest 50,000 rupees and see where it takes me. But doing this, you have already spent 20% of your investment amount as fees. That means the portfolio has to beat the index by 20% for you to just break even, which we don't think is ideal and which is a very big ask on any strategy. So we think the rule of thumb should be that target a fee that is 2 to 3% of your eventual investment amount. So you may start with 50,000, but you should have a view that I want to invest a certain amount where the fees that I pay for investing in the portfolio is worth it. Second question is, are you okay with being wrong? So as I just said that 50% of the times 50% of the times the stock that you pick in the momentum portfolio is going to end up in a loss. So are you okay with being wrong so many times? And if you are, then you will be fine with investing in such a strategy. Then what are your expectations? Do you think that, because I'm investing in a certain strategy with a fancy name like momentum, it should always outperform? No, it does not. Actually, there is no silver bullet in stock markets. We have looked at the data in the past and we have run this. You'll be surprised to know that 1 in 3 times, there is a 1 in 3 chance that the momentum strategy will trail the index. And this has happened while we are running the portfolio in live markets as well. That's just the nature of the strategy. Then if you're like, no, I don't want any down years. I want markets just to go up and I want my portfolio only to go up, then probably this strategy is not for you, and probably equity investing is not for you because markets are going to correct and markets are volatile. If you look at in 2000s, just after the dot-com bubble, markets fell by 55%. In 2008, the index fell by 60%. Even as as near as 2020, the index fell by 38-40%. So there are going to be down years, there is going to be pain, but you should expect that to happen. And then, yeah, if you're looking at the strategy and only at the last 4 or 5 years, and you're saying that, boss, I need 30% return from the strategy, I need a 30% CAGR, and that's not an realistic expectation because over very long term market returns 13 to 11 to 12%. Yes, if you're investing in a high beta strategy, if you're investing in a factor based strategy, and if you see the backtest, then you can be confident that yes, there is a probabilistic chance that you'll be able to beat the index, but having an expectation of generating 25-30% returns is not realistic. So yeah, this was me giving you a very broad overview of momentum investing and talking about factors and talking about things that happen when you invest in a momentum portfolio. So I think now is a good time where we take questions from you, and we have got some questions that you have already shared. So probably a good time to answer them now.
Hey, Heath, thank you. That was nice and informative session. We do have some questions. Before taking the questions from the chat, we have asked people to send us some questions. So I will start with that. The first question is basically on a broad level, what are the filters do you consider while while figuring out, okay, we have momentum in this particular sector or in this particular stock?
Right. So I'll talk about Capitalmind momentum. So we predominantly look at the Sharpe ratio. We have also published a paper. Uh, Anup Vijay Kumar, who is the head of research at Capitalmind, he has published a paper about how we invest in Capitalmind momentum. If you just Google, you'll find the link, or probably we'll add it in the description. So we predominantly look at the Sharpe ratio, and then we also apply few more filters, which constitute filters using moving averages, which also uh, look at volatility. And the research is out there. There are many different ways of using different filters over and above the momentum filter to filter stocks.
Okay. Also, Nihit, do you look at fundamental part of the stock while analyzing, while while considering a stock into the moment investing? Do you look at fundamental side of things of
No,
that
we
company?
No, we don't. The momentum factor does not take into consideration fundamentals. Momentum strategy is based on price action, it is based on price trends, it is based on price of the stock. But when we practice momentum investing, we do keep an eye on the news flow. We do keep an eye on what's happening with the stocks that we have added into the portfolio. But rarely we do take actions basis news flow. Sometimes some news comes like a very the news is very harsh and we see that this will very negatively impact the stock. Those are the rare occasions when we take action based on news. But fundamentals are seen as a hygiene check. So when you are adding stocks to the portfolio, sometimes you know that a certain stock is showing price momentum, but the stock is nowhere worth investing it, and you know for a fact that there could be a big uh, you know corporate issue coming in. At that point, you put it as an hygiene filter to not include that stock. Uh, but that also a very rare phenomena. Generally, for most of the times, we don't look at fundamentals at all.
Okay. So tell me this, Nihit, at what times momentum will not work?
Okay, so as I said, in 1 in 3 times, momentum strategy will underperform. But momentum will not work when the whole equity market does not work. It is an equity linked strategy. So when the markets fall, a strategy like momentum will also fall with it. We have also seen that whenever price trends start and end very fast, at that point of time, momentum investing does not work. So in a sideways market or in a choppy market, you will see that momentum strategy struggles.
Okay. So, Nihit, in one of your charts, you mentioned that around 50% of the positions end up in red, and then we exit them, and then the remaining positions will more than make up for this loss. So, on a broad level, with that kind of strike rate, how do you manage risk?
Yes. So I'll 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 generally say that risk is managed because we have a portfolio of 20 stocks and it can go up to 25 stocks. So when you are diversified into a lot of stocks and into a lot of positions, your portfolio volatility gradually comes down. A concentrated portfolio tends to have higher volatility, whereas a diversified portfolio tends to have a lower volatility. And volatility is a proxy for risk. So a diversified portfolio will anyway bring your risk and your volatility down. Then we also do position sizing. So we start with a position with a certain weight or with a certain allocation, and we let the winner run so that the weight of the position keeps increasing as the stock keeps performing. And if a stock does not perform in the portfolio, the allocation of that stock remains low, and then it does not perform, and then we exit it. But apart from that, when you know that 50% of your stocks are going to lose, you can't really do much about it. You just have to be nimble. You have to be responsive to how the stock price moves. And probably that is where a weekly rebalancing helps. Sometimes we get feedback that you're rebalancing too frequently. Why do I have to look at a long-term portfolio every week? But because you have to be responsive and because price trends change very fast, one of the smaller ways in which we manage risk is that we look at it every week and we rebalance every week.
Okay. Nihit, before I go to YouTube comment section, so I have one last question from my end. Um, is momentum an anomaly? So basically, has it worked in the past? If not in India, globally, do we have enough data, not just 10, 15, 20 years, maybe moving to decades of data, saying that momentum, even though it is an anomaly or not, please help us understand, but it has worked for the longest period of time and not just a few years or few decades.
Yes, so as you said, it is famously quoted that momentum is an anomaly. Uh, the person who's who talked about efficient market hypothesis is the same person who also admitted that it is an anomaly. So we are not able to explain why it works, but the data, not of India, of course, we have very few decades of data, but data from the US markets, which is more than a century. There we have tested, people have tested it. There is proven research which shows that momentum works, and it's quite intuitive. In all asset classes, even if you look at real estates. So whenever the market is going up, whenever the prices are increasing, more and more people keep buying, and they are chasing momentum. In a way, if you look around you in different asset classes, in different things, people chase momentum. A team that is winning on a winning streak, or that is performing well, keeps performing well. So in markets, it is an anomaly. It is not explained through uh, through basic fundamental theories, but data has proven that it works. And we run Capitalmind momentum strategy in our PMS and on our small case, and we have seen this anomaly working out for ourselves.
Okay, so let's take questions from the comment section. So does SIP work in momentum investing?
So SIP is a way of investing into the markets or into any asset class. So SIP means you gradually add money into a strategy or into a portfolio. So if it suits your asset allocation, if it suits your investing style, why not? You can gradually invest into a strategy. And if you're investing for a longer duration, more than 3 years, then SIP is a good way to invest. uh, Even lump sum is a good way to invest in momentum strategy, because momentum strategy, we are rebalancing every week. So every week you are entering into the stocks and exiting the stocks. So the risk of being getting invested at the top with a lump sum amount is lower with a strategy like momentum than with a strategy like with value or fundamental investing. So short answer, yes, SIP works. It's a great way to invest for people with salaried income or regular income.
Okay, so how is our small case, Capitalmind small case, different from other momentum offerings in the market?
Okay, so we don't exactly know how others do momentum, but generally, and to be honest, momentum investing is not something which is created by somebody. It's a factor which is well established, which is well studied, which is well documented. So anybody who practices the momentum factor with purity, with honesty, and as per the rules, will have kind of sort of similar portfolios. But the key part here is in practicing the momentum factor and consistently applying it to create a portfolio. I'll give you an example. So when sometimes you're applying the momentum factor and you see that a certain stock is going to come into the portfolio, and you hate that stock, you don't like that stock, and you have probably heard news, or you have heard from somebody you respect that this stock is not at all good. So what you do, you say, I'll take a deviation and I'll not add this stock in the portfolio because of my own bias, of because of my own background or my understanding or my over understanding. So then you're not a practitioner of momentum investing. The the key and the secret and the crux of investing into a factor based strategy is to remove all emotion from the
Yes.
equation and invest just based on data. So I can't answer how we are different. Uh, but yeah, there will be some strategies who rebalance every month. We do it every week. There will be some strategies who will be taking different parameters for momentum, say relative strength index, or say moving averages, or uh, some would be taking 30 stocks, some would be taking 10 stocks. Some strategies will focus on small and mid caps only. Some would be market cap agnostics, like we are. So that kind of differences you can figure out by reading the description of the strategy and talking to the fund manager. But beyond that, what formula they are using to arrive at the stocks that goes into a portfolio, we have no way of comparing. Even we don't disclose the algorithm that we use to add stocks in the portfolio. But yeah, frankly speaking, anybody, and even you, if you practice the factor of momentum and if you can create a momentum portfolio based on the factors that are already documented, and there are papers and there's theory. If you practice it with purity, you have a good momentum portfolio.
Nihit, how do you pick momentum in bear market? Let's say there is absolutely no momentum, the breath is weak, and no stock is moving,
Right.
literally. So how do you pick momentum in those markets?
At Capitalmind small case, we do relative. We are using relative momentum. So we take a list of stocks, and when we figure out which are the strongest stocks from this list of stock, and they go into the momentum portfolio. Now, in a bear market or in a weak market, the data only shows that these are the stock. There are very few stocks that are passing your criteria of being into a momentum portfolio. So we know that the market is weak and there is lower momentum in the market. At this point of time, we also have we also have a framework in our momentum small case to go into cash, and these are the opportunities where we know that we are getting very few stocks in the momentum filters, and then we know that the market is weak, so we take a cash call and we sit into cash. Sometimes this cash call has really helped us. During COVID crash, we were heavily in cash, so our drawdown in momentum small case was as little as 18 to 20%, whereas the market fell by 38%. But some other times when we have taken cash calls, it has not worked well for us. As soon as we have taken cash call, the market has reversed and it has gone up. And so we have lost out a bit of returns there. So in bear markets or in weak markets, two things: we get very few stocks that we could invest, so we move into cash. And secondly, even when we are investing in a bear market, we are still picking stocks that are the strongest. So that is also an opportunity for us to do little, to fall little less than the whole market, because anyway every week we are going and fighting for stocks that are the strongest even in a bear market.
So is momentum strategy more suitable for small cap stocks?
No, momentum works everywhere. Momentum works on gold and commodities also. So it's not just that it is suitable for small cap stocks. It's just that in the recent past, small caps have seen a phenomenal rally, and more small caps are popping up on the momentum filters, and we are buying them. But if the trend changes and if small caps see a stagnation, you'll see more and more large cap stocks coming into a momentum portfolio. So it's, according to us, it is a market cap agnostic strategy. I'll go ahead and say that it is not even a strategy that you can apply only to stocks. You can do it to gold. You can do it to other asset classes also.
Okay. So also since Anit, you mentioned that it's a high churn portfolio, we have weekly rebalance, correct? So can you talk about the tax angle of it, the tax, how the STCG, LTCG will impact the overall returns of the portfolio?
Yep, taxation is real. So uh, this is a very high churn portfolio. So assume that all the stocks will be sold within a year. There are few stocks that we hold for more than a year also, but let's not consider that. So whenever you request us to know the past returns, or whenever you see the past returns anywhere, uh, just just assume that you will be paying 15% STCG on all the returns. So if you see a portfolio which is showing 10% return in a year, assume that 15% tax has been paid. So you'll essentially realize only 8.5% post tax. So for high churn strategy like momentum, assume short-term capital gains. And if you're earning more than 50 lakhs or 1 crore, then assume surcharge also.
Okay. So do you have any coupon code running right now for momentum?
Yes, whenever you want to join, you can request us for a discount offer. If we have any running, we'll always share the best one. So I think we have a coupon code. You can use the code CM for Capitalmind. So CM Coffee, COFFEE, for a 15% discount code on Capitalmind Momentum applicable to all plans. Probably you can put it in the chat window as well.
Cool. So this may be more into the advisory side of things, but I'll just ask, what percentage of one's overall equity net worth should be part of momentum?
Okay, so yeah, this comes under advice. So we can't advise. We can't tell you how you should invest. We can't tell you how much you should invest because we don't know your risk profile. We don't know your earnings. We don't know if you have insurance or not. We don't know what are your goals. So I can't tell you. Nobody can tell you. Nobody should tell you how much you should invest. What I can tell you is don't invest 100% of your investable amount into any one strategy. You should diversify. If you're doing something like momentum, uh, also invest into a fundamental based portfolio, be it through mutual fund, be it through small case, be it you are doing it yourself. Have allocation to some fixed deposit and some debt investment as well. No matter how confident you are feeling about a portfolio or a strategy or a factor, don't put all your eggs into one basket. This is a cliche, but in stock markets, this is very true. So yeah, that is only one thing I can tell you, that how much ever you get convinced through webinars like this or through reading white papers or through your friends or through influences, don't put 100% into any strategy. Diversify. If you can find five good strategies, why not do all of them? There's no harm. Like, I am an advocate of the fact that if you find five very good companies, you don't have to pick one of those five. Invest in all five, because markets are unpredictable. You don't know what will work. So if you can bet on five good horses, bet on all five. And it is not a race that only one will win. Probably all five can win. So that's my general gyan on how you should diversify and how you should think about it.
Nihit, I have one more question from my end. So, how much of momentum investing is psychology than the data crunching? Because the one of the principles is intuitive, correct? So, the intuitive form of investing is pick the stock that is doing not doing good. It can be value, or it hasn't done anything, 52-week low, etc., etc. But here, the momentum investing is doing something that is not intuitive, but having a psychological mindset to still believe in the strategy. So, as a new investor, let's say if someone wants to enter momentum, what is that dichotomy? How can one balance it out? The usual way of looking at a company, looking at a stock price, vis-a-vis the momentum side of looking at things.
Right. So as you said, it's a dichotomy. It's counterintuitive. Sometimes when we are also looking at stocks and adding in the portfolio, we see that the stock has run up like 100% in the last 1 year. And you don't feel like adding that stock into the portfolio. You're like, "Hey, boss, this has run up so much. How much more can it go?" But as Deepak Shinoy, who's our CEO, he says this, that if a stock is going up, then it's good only. No, the job of a stock is to go up. If the stock is going up, that means people are putting more money into the stock. The company is doing something right. So as we saw with data also in the presentation, if a stocking is going up, it's a sign that good things are happening with the company. And that way, then when you look at it this way, it makes it intuitive that stocks that are going up are the ones that you should invest with. But since our conditioning since childhood and our conditioning around us is that you should buy things cheaper, and you should buy things that offer more value, and which is great and which is true as well. Uh, Anup Vijay Kumar, who is head of research at Capitalmind, he has published a fantastic post which is titled "Demystifying Momentum Investing." There, he has shared data that uh, our Capitalmind PMS momentum strategy, which is on real money, the strategy does really well, and it has outperformed a lot of benchmarks here and there, and it has done very good. But still, he would see that if you compare it with flexi-cap mutual funds, the strategy will be in the top decile or the top 10% of the mutual funds, but it will still not beat the very, very best value-based mutual fund. This is because that in stock markets also, if you buy things at low and sell at high, that is the best return. But momentum will always be in the top 10 percentile, but it will never be the best. So that way, intuitively, yes, buying cheap and selling high will always be the best result. But after that, uh, also you don't know which will be the top mutual fund all the time. So at Capitalmind, we say that you should aim to be in the top 10 percentile or the top 5 percentile, but you can't aim to be the best performing fund or best performing portfolio every year. So that ways, if you know exactly what is right now absolutely at the bottom and can go at the top, that will always win. But when you don't know that what is really cheap right now and can like go multiple times in few years, buying stocks that are breaking new all-time highs is a good idea.
There are enough questions on exit strategy. They want to know when do we exit stocks.
Right.
So can you just spend some time on how do we choose to exit stock?
Sure. So exit, there are filters. So all the whole capital mind momentum small case strategy is based on data. It's based on quantitative filters. There is little or no discretion, and some discretion is there. We also have a framework for it. So when the definition on when we should exit a stock is whenever a stock loses momentum. So how do you figure out if a stock has lost momentum? So we would have filter based on moving averages. We'll have filters based on Sharpe ratio. We'll have filters based on relative strength index. We'll have filters based on volatility. And once a stock fails these filters, some of it, all of it, or a set of it, that means that stock is now has now lost momentum and we need to exit. Of course, there are few other conditions that I'll not be able to state here. But yes, there's an formula that tells us that this stock has now lost momentum, and as the stock loses momentum, we then don't apply any discretion on it, and then we exit that stock. Uh, so as there are entry conditions, similarly there are exit conditions. One thing I could tell you that we don't apply exit conditions every week. So suppose if I added a stock today, I will give it at least a month uh, to apply the exit conditions and to let it perform or let it perish. Uh, and that ways, a little technicality here is since the momentum portfolio is a weekly rebalance. Yes, we do the rebalance every week, but review for stocks is a monthly process. It is not done uh, like after adding every week. We don't review that stock. We review it after 1 month.
So is it safe to assume that on weekly basis we review, but the rebalance happens as and when necessary? It's not that every week we do rebalance. Is my
Yeah,
understanding correct?
take care that we don't want the churn to be very high. So for a stock, the rebalance will happen after a month or it will happen at a monthly level. But different stocks will follow different cycles. So every week you will have something or the other showing up. But it is in our framework that we don't want to do unnecessary churn. So our filters are also designed that way that you don't get unnecessary. You can run the portfolio every day. You can run the algorithm every day and it will throw out stocks every day. But you just can't keep buying and selling stocks and increase your transaction costs and increase your churn and also lose your peace of mind trading stocks every day. So once a week is a best fit right now.
Right. Kalpak is asking how many books are there behind you, and can you suggest some books apart from the famous ones like Psychology of Money, Rich Dad Poor Dad, etc.
Okay, so I am right now sitting at at a library, and this is also our one of our offices where I work out of. So I think there are more than 2,500 books here, and one of my favorite way to relax is I grab a cup of coffee and I just look at the titles of the books. I don't have many book suggestions. I really don't read that many books. I'm more of a podcast person. But again, I'll refer to Anup Vijay Kumar from Capital Mind. He has a fantastic thread on his Twitter account where he suggests books. And one of the books he suggested me personally when I was having a little health issues was this book titled Outlive. And I read that book and it is fantastic. So I don't have book suggestions from stock market. You should refer Anup's thread, and he has fantastic suggestions. Those are not the common ones, but the different ones. But right now, I'm focusing on my health, so probably my suggestion would be to read Outlive.
Cool. So that brings us to the end of this session. I hope everyone who has joined has gained a better understanding of what is momentum investing. And if you want to learn more about momentum investing and how do we do at Capitalmind, please do check out our small case at capitalmind.smallcase.com or visit our website at premium.capitalmind.in. So as we already mentioned, we have a discount coupon running for 15% off on our all the plans for momentum portfolio. Use the code CMCOFFEE, CMCOFFEE to get 15% off to all the subscribers. So we'll share the coupon code in the description below as well. Once again, thank you so much for joining. Nihit, you want to add anything at the as a end note?
Yep. So thanks, folks, for joining on a Sunday morning, and I'm glad that we could finish this session before Sunday morning turned into Sunday afternoon. And if you have any questions, write to us at smallcase@premium.capitalmind.in. We read and reply to all emails. Any question that you have, any information that you need more about Capitalmind Small Case, we are here to answer all your queries. And let us know in comments if you would want us to do more such sessions. If you want us to touch upon on any topics that you would want to know more about, and we'll be very glad to do this for you. We enjoy this part of the Sunday where we get to talk to you guys, so that's not at all a problem for us. Once again, thank you so much for joining. Hope you have a good Sunday. Thank you.
Happy weekend, folks. Bye. Take care.